Well, another retailer under pressure today is Best Buy. The company saw same-store sales fall more than expected in its third quarter on what the CEO called, quote, uneven consumer demand. Now, this weakness causing Best Buy to cut its full-year guidance. You can see it's currently off about 2% so far this morning. Now, our next guest is not surprised by this result. He said in a note previewing the quarter that he expects weaker trends to continue into the holiday shopping season. Let's bring in Seth Basham, Wedbush Securities Managing Director of Equity Research in Retail. So Seth, walk us through your base case here for why you're not surprised by the results you're seeing this morning.
Yeah, it's simply a trend of consumers spending less on big ticket discretionary items. We saw this trend accelerate after Labor Day, and Best Buy is right in the throes of that, considering how many items they sell in their store that are big ticket and discretionary. So consumers are pulling back on those items. It's appliances, it's TVs, it's items along those lines where they're seeing the most pressure.
Now, as you look at some of these segments that we have a breakdown of here, is it about price or is it about supply and demand? Is the consumer ever going to come back to these big ticket items with inflation still being so high?
Well, core inflation, what consumers need to spend on every day, is certainly dragging down the amount of money they have to spend as discretionary items. So that's not helping. Within consumer electronics, we're actually seeing some signs of deflation. TVs, for example, and that's leading some consumers to buy a bigger screen TV. But overall, we're seeing more trade down effect than not at this point in time, and consumers are tightening those purse strings. So we're not expecting a jump in sales in the near term.
So what do you think is going to be the turnaround story for Best Buy here? If you see this pullback, people are clearly bought everything that they needed at this point and are really just focusing on non-discretionary items here. What's the turnaround prognosis for Best Buy?
Yeah, there are two pieces to it. One is consumer sentiment. So consumers feeling better about their income, better about their spending power, and continuing to spend more on goods relative to services after a shift back to services in the last year or so. The second piece of it is the product replacement cycle. So we've seen consumers buy a lot of consumer electronics during the pandemic. There was some pulled forward demand, whether it be in laptops, whether it be in gaming devices. We're at a point now where many of those devices need to be replaced. That installed base is larger, and consumers are going to say, wow, I need to do something different here. My device is getting outdated. So that replacement cycle could start to accelerate in 2024, especially as innovation comes back to the category.
And Seth, as we look at the holiday season, we know that it's kicking off earlier and earlier, and they were one of the first companies to really kick off their promotions, and that was in mid-October, it seems incredibly early. But then for some of these companies trying to balance their promotions with also keeping an eye on those margins, how well positioned is Best Buy for that?
Yeah, certainly the holiday season is starting earlier than it did pre-pandemic, and promotions are probably up overall a little bit to pre-pandemic levels. And certainly up a bit year over year. Now, the companies are planning for this. Best Buy has some offsets against the promotional pressure from things like its loyalty program and increased services revenue, which is very high margin. So they're taking that into account. But the key holiday events of Black Friday, Cyber Monday, and the last 2 weeks before Christmas will be absolutely critical to how the season plays out, both from a top line and margin perspective. At this point in time, the reduced guidance that Best Buy provided for the fourth quarter, we think is achievable.
And you mentioned some of these promotions, but why do you think that Best Buy is better positioned, especially looking at some of your predictions for gross margins?
Yeah, so one of the big things for Best Buy is vendor support. They got a lot of vendor support to help promote products. They got a lot of vendor support to manage the space inside the store within a store concepts. And that really helps them on the margin side. And some of these dollars from vendors can shift between cost of goods and SG&A, which will impact the geography of the income statement. But overall, the vendor support is very strong for Best Buy because they control 1/3 of the consumer electronics industry in the US.
And Seth, I do want to ask you, obviously, when it comes to credit card spending, we've seen, all the headlines, $1 trillion worth of consumer credit card debt that people have. How is Best Buy managing that, especially since they are one of those companies that does have these big ticket items that people would tend to finance?
Yeah, there are two things to think about there. First of all, Best Buy's average customer skews to be a little bit higher income than the national average. So that helps them because we're seeing that low to mid income consumer under more pressure right now. They're exhausting their savings from the pandemic and dipping into credit cards to support spending, and therefore pulling back more than that mid to high end consumer. Secondly, Best Buy itself does have a big credit card portfolio profit sharing program with its private label provider. And we're expecting some pressure on profitability from that program into 2024 as those delinquency rates and loss rates rise. So right now, we think that they got that under control, but it's a headwind to drive margins in 2024. It's likely going to cause them to see operating margins flat to down in 24, even in a sales environment that's flattish.
So, Seth, as you compare it to some of its peers in this space, how would you rank it in terms of some of these other big box stores that are in a similar range?
Yeah, Best Buy, I think, is very, very tied to the macro right now. Some of the other companies in the hardline space have more store growth drivers, have more innovation helping them. And those things are not behind Best Buy at this point in time. So along with the credit card income headwinds that I mentioned, I'd say Best Buy is a little bit worse positioned.
I appreciate you taking the time to join us this morning. Seth Basham, Wedbush Securities Managing Director of Equity Research in Retail. Thank you so much.